So you're telling me, even though we're going to the grocery store and paying, what did you say, 11% more for the food that we eat, there's still hope?
Absolutely. This too shall pass. Things are transitory, even if they don't feel like it at the time. We know it's painful, but it is temporary. It will not last forever. And in the meantime, we here at Mountain America, we have people that can look at your financial situation and we can help you figure out where you need to go from here, whether you're borrowing, whether you're saving. Our whole goal, the whole reason we exist, is to help our members get to a better financial place.
Chad, we're talking today about really the state of our economy, why we're in this environment we're in, which I think for our everyday member, even our everyday viewer, anyone that's listening in, we're all wondering, what is going on?
That is the question.
What is happening? Yeah.
Why are things so stressful? Why is the economy seeming to implode? What's the Federal Reserve doing?
Yes, exactly. And I actually was at a presentation a few days ago, and it was about like leadership and jobs and all the things. But the presenter said, oh, we're all in this heightened awareness of like stress, anger, anxiety just from the past few years. And then she's like, and the economy on top of it is not helping with all of that. So tell us, why are we in this current environment? And what really is, I mean, can we blame it on the Federal Reserve for raising rates? I mean, what do we do here?
Well, the funny thing is I was just at a conference and one of the presenters mentioned that, it's a weird time when he gets in an elevator and someone strikes up a conversation with him asking about the Federal Reserve. He said, usually it's just the numbers geeks. It's people like me that will be talking about the Fed. Most people kind of go through their lives blissfully unaware of who the Fed is, what they're doing.
Yeah.
But it's kind of entered into everyday conversation. Everyone's hyper aware of the Fed because they've been taking such strong actions this year. You mentioned, we're coming out of this period of the pandemic and just so much economic turmoil. And the Fed, as I said, is taking some pretty strong actions this year. And why they're doing that is that those that remember the 1970s, we had a period then of high inflation, kind of similar to what we have today, but they also had a period of very high unemployment, and that's called stagflation. And so even though the Fed had existed much earlier in the 20th century, Congress kind of came back to the Fed in the late 1970s and said, okay, we're changing your mandate. We're going to change what we want you to do. And really, there's certain things you need to focus on.
Okay.
One of those is we want you to focus on maximum employment. Now, that's not to say 100% employment. That's actually never optimal.
Right.
Because people always need to quit or move jobs. And, one company will go under, another company will start up. Certain industries will ebb and flow. So you want maximum employment, typically, like maybe 3-4% unemployment just to give people some ability to move, if that makes sense.
Yeah.
So on the one hand, they're supposed to focus on that. And on the other, they're trying to focus on having stable prices with moderate long-term interest rates. And that's a very long way to say is just some certainty, right? People want stable prices in order to know that the value of their money isn't really going to change. And that allows them to make plans.
Yeah, and plan for our future and know, hey, I can afford gas next month.
Exactly.
Or whatever
So people, when they talk about the Fed, you often hear the phrase that the Fed has a dual mandate. And that's really what it is. So on the one hand, they're supposed to focus on ensuring strong, healthy employment. And on the other hand, they're supposed to focus on maintaining stable prices with those long-term interest rates that are fairly moderate. In other words, controlling inflation.
Okay. So is that what they're doing right now, is trying to control inflation?
That's exactly right.
Okay.
As you know, through the pandemic, we had ongoing supply chain issues. And then due to a lot of the relief efforts, both under President Trump and President Biden, the government has printed and spent a lot of money. Then you have the war in Ukraine. I mean, there's this long list of issues we could go through, but the end result is inflation is just so high. It's gotten really out of control. And so the Fed is trying to use the lever they have over here in controlling interest rates to try to get that inflation much closer to their long-term goal of 2%.
Okay. And what, if you could define inflation for me in layman's terms, what would that be from your perspective?
Well, there's so many textbook definitions.
Yes.
I would just say, how do people feel it? It's just, the prices spiral up a lot faster than normal. And typically it's the result of, too many dollars chasing too few goods.
Okay.
So typically, like I said, the Fed likes to see inflation around 2%. It allows prices to gradually increment. But we're seeing overall, for the 12 months just ended in September, overall inflation for those 12 months is about 8.2%.
Okay.
And again, that's an average for the consumer price index. There are certain segments like food is up over 11%, energy up almost 20%. So I know that our members are feeling it in the grocery store and at the gas pump and paying rent and every other aspect of their lives.
Yeah, absolutely. So then interest rates are going to increase and that'll bring prices down. Is that right? How does this work?
Yeah. So I guess the way to explain this is the Fed knows they have to inflict a little bit of pain.
Okay.
And that sounds horrible to say.
Yeah.
But what they're trying to do is by using interest rates, if they can increase interest rates, then people tend to borrow less. Both people and companies are a little more hesitant to borrow because it will cost more to service that debt and make the payments. So if you're a consumer, you might say, well, we were going to take a vacation. We were going to remodel the basement. We were going to have this major purchase. Maybe we'll hold off a little bit and cut back on some of the discretionary spending because we don't want to borrow to do that because it costs so much more. Then on the business side, they're also maybe not seeing so much demand from the consumer because they're cutting back. And then also they're looking at their own situation going, maybe we don't expand. Maybe we don't build this new building. And so overall, by raising the rates, the Fed can take liquidity out of the economy and slow things down. And what that'll do is that will reduce the demand for employees, unfortunately. And so typically when the Fed's doing what they're doing, it does cause a little bit of job loss. But they're trying to kind of thread the needle. They're going for what they call a soft landing, by which they can inflict a little bit of pain, but just enough so they don't tip us into a recession, but just get that inflation number down where then they can kind of back off and say, okay, we got back to normal again.
Okay. So you said the word recession. I feel like, you turn on the news any time of the day, that word is being thrown out there. Are we in one? Are we not? Are we headed for one? Are we not?
Depends on who you ask.
Okay, fair enough.
Textbook definition historically has been 2 consecutive quarters of negative GDP. Okay. So textbook definition, we likely are in one. But that said, what you're hearing from the Fed is they're like, this doesn't really feel like a recession because we're still seeing very healthy employment levels and we're seeing healthy labor force participation.
Yeah.
So I would just kind of say, if you ask any person, are we in a recession? It's kind of what it feels like to them. Does it feel like they're in one when they're filling up their car? Does it feel like it when they're buying milk?
Yeah.
That's going to probably be your touchstone. And that answer will be different for different people.
For each of us. And kind of going back to your definition there, for those of us that don't know, what is GDP?
Gross domestic product. So it's just kind of the overall contribution of the economy.
Okay. Awesome. So yeah, depends on who you ask if we're in a recession or not. Totally makes sense. Any other thoughts on why this is happening right now, or have we kind of covered all of that?
Well, again, I think the supply chain was strained. You had 2 years of people really essentially being confined to their homes, not able to go out and do things. So I think they bought a lot of the goods that they wanted. Everyone got their Peloton. They got a lot of, they got, certain things delivered to make their home life more livable for the time of the pandemic. And then I think once those restrictions started to be lifted, I think you're seeing people want to go out and have experiences again. And so you're seeing this pent up demand for travel and for certain goods that you couldn't have during the pandemic. And I think that kind of made those supply chain shortages, it heightened that a lot more. And I think people felt it. So in a sense, we're still catching up a little bit.
Okay.
And then again, with the government infusing a lot of money into the economy, which can be argued that it was needed.
Right.
You can't print trillions of dollars and not have that also have an effect on the value of the dollar.
Yeah. And so what does this really mean for our members, the public? What do we need to do from here?
Well, what does it mean? For those that are in a position to borrow, of course, we realize it hurts, right? It becomes much more expensive to take on debt and service that debt. But on the flip side, if you want to see a silver lining, for years, when borrowing rates were so terribly low, people that were in a position to save were saying, I'm earning absolutely nothing on my savings. So when rates do rise, the flip side is that people that are in a position to save all of a sudden can get some good return on those dollars that they have to save.
Okay, so when it comes to getting a good return on our savings, right, we're looking at the silver lining here of gas prices and all of the things. How do we really choose how to save our money? Like, what's the right place to put it? Because the stock market every day is up and down and through and above and, below. Right. It just is crazy. Even just, today as we sit here, it's gone all over the place.
Oh, exactly. And again, there's so much uncertainty there. So there really is no one size fits all right answer to that. So much will be that it depends answer. Depends on your appetite for risk. Do you just have a few dollars to save and you're going to need those in the short term? Do you have sufficient liquid savings and you just have some excess funds you're looking to have work for you a little bit? Is there a certain long-term project that you're trying to save up for over time? So it really depends on your strategy and the ultimate goal.
Okay, so we've got to define what our goal is what you're telling me.
It helps.
Okay, fair enough.
Probably a good idea.
But tell me a little bit when it comes to savings. Obviously, you mentioned liquidity and our short-term goals. We all know we need to have that savings account for emergency funds.
Absolutely.
Right. But beyond that, we obviously will likely have a 401k, things like that. What are some other things or strategies that we can use to take advantage of these interest rates right now?
Well, the first thing I would say, it might sound a little counterintuitive, but if you're going to focus on your savings, I would say start by looking at your borrowings. Look at your debt. Because again, as interest rates rise and that debt you have is getting more and more expensive to service, it might be worthwhile to look into if you could consolidate or move some of that debt into a lower fixed rate loan, even the same type of loan, just with a different institution, maybe at a different or better rate. Because again, if you're paying on this already, everything else in your budget staying the same, any dollars that you can free up that you're currently using to service your debt, that just becomes money you can save.
Yeah, I love that. I actually heard this story from one of our members recently where they went in thinking that, they just needed a personal loan to help with their daughter who was, graduating and trying to get into a car, right? So she could move on in life. And they ended up being like, why would you get a personal loan for this? You have equity in your current vehicle. In fact, let's consolidate this other credit card too.
Nice.
And they ended up getting a way better interest rate for all of the things, right? So is that what you're saying? Like,
That's
let's
exactly
review
what I'm
it
saying.
all. Okay.
It's not that you're taking on new debt or putting yourself in any different situation than you're actually already in. It's just a way of reorganizing things such that a lot less of your current income will have to go to interest costs on that debt. And that becomes money that now you can spend as part of your budget or optimally you can save.
Okay, so let's say we have those extra funds, right?
Okay.
We've looked at our debts. Those are, as low as they can be for right now. What are some of those saving opportunities that we have?
Okay. Once again, I would just say it goes back to what is your plan? What's the strategy for these funds that you have? Because if you need them accessible, if you need to be able to get to them frequently or in the near term, you're probably not going to want to maybe look at a certificate account. You'll want to focus on a savings or a money market account because those will be fully liquid. They're able to be withdrawn at any moment. You can get to them as often as you need. If your time horizon's a little longer and you have some time, you can typically get a much higher return by looking at something like a certificate account.
Okay. And what is a certificate account? I think there's a lot of people out there, right? Is it a term deposit? It's a CD? Like, what are all of these things?
Oddly enough, those terms all describe pretty much the same thing. So if you hear certificate of deposit, CD, term deposit, they all describe basically the same thing.
Okay.
Banks and credit unions will have different terms for it, but essentially it's just an account where a certain amount of money is set aside for a certain period of time.
Okay.
And then it earns a stated rate of interest during that time.
Okay. And so because of this environment that we're in, certificate rates are good.
Oh, they are getting better every day as well. As the Fed's increasing rates on the borrowings, certificates are pretty much keeping pace.
Okay. So what would you say is typical? You mentioned a set amount of time for a specific amount of money. Are there like minimums that we have to contribute to these accounts? What does that sometimes look like? And I'm sure it depends, right? Who you get it through.
It does depend. By and large, there are some basics with certificates. So your standard certificate, just everyday certificate, typically the way that works is there usually is a minimum deposit, let's say $500.
Okay.
Typically there's not a maximum though. So I've seen some fairly large certificates. It's just whatever that comfort level is. And you pick, first of all, a term. So it may be as short as 6 months. It may be as long as 60 months. You may go out 5 years. And essentially, there's a little bit of risk and a little bit of reward on both sides. So you as the person making the deposit, the risk is, okay, I might lock this up for 5 years. I may need access to this money. And if so, there's a little asterisk to that. You technically can get to the funds if you need to, but there's usually a penalty for doing so. And that's usually a certain number of days worth of the interest that you've earned or might have earned.
Okay.
So it's not like they're completely locked away, never to be touched, but you typically don't want to break those early and incur that penalty. So you have to look at that time horizon, and then you also usually have to have that minimum amount. But other than that, you make that initial deposit, and then it's hands off for the rest of that term. The amount doesn't change other than just the earnings that you're getting on that month to month.
Right.
And then at the end of the term, that matures, And you can either then move that back into a savings type product, or you can just renew and roll that into another term.
Okay. So correct me if I'm wrong. There are some strategies that you can follow
Sure.
to make it maybe that 60-month term not hurt so much, right?
Yeah.
So,
for example, a very popular one is laddering. Some
Okay.
of our members and our listeners may have heard of the concept of laddering, and that's where, let's use an example and say you have $50,000 that you're looking to place. Okay, if you put that out in one 5-year certificate, what happens 2 years from now if all of a sudden you have some kind of emergency? You might need 20,000 of those dollars.
Sure.
You'd have to break that certificate, incur the penalty on the whole 50,000, and then at that point you also lose that interest rate because maybe rates changed in the meantime, and you have to redeploy whatever funds you don't need. So what some people in that situation would do is, instead of placing all 50,000 into one certificate, they'd break it up into 5 chunks of $10,000 each. And then they'd open a 12-month, 24, 36, 48, and 60. So basically rungs on a ladder, each one a year apart.
Okay.
And then what will happen is, a year from now, that first certificate now matures. If you need it, you can move that into savings and have access to it. If not, you place that out into a new 5-year rung. And then every year, those kind of march down, and every year you'll have one mature that you can either then use or place back out on the 5-year point. But that way you know that you always have some portion of that money coming due within the next year, just in case you need to use it.
Okay. So from your perspective, let's say that, $50,000, not a lot of people are just going to have that on hand to throw into, 5 years laddering worth of certificates.
Exactly.
Is that going to make sense for something as small as $500 each? I mean, rates are good enough, right?
Right. And again, there are even other alternatives to that. So for those that may not have as much to invest, there are some options that can be added to the standard certificate, or some variations on it. One of them that we offer at Mountain America is called a growth certificate. Now, it has other names elsewhere. It might be like a flexible certificate, something like that. But the way that works is they usually have a much lower opening balance, as little as $5. So you may have someone that says, I don't even have $500 to open a certificate, but I'm not earning much on my savings, and I'd really like to take advantage of these better rates.
Yeah.
Well, you can open a growth certificate for, let's say you have $25 to start with. Great, open that. You lock in that rate. Let's say you did a 5-year term. So you lock in that rate for the next 5 years. And then as you get your paycheck, as you might have another $10, $15 to deposit, you have the ability to keep adding to the growth certificate.
Okay.
Whereas unlike the standard certificate, you just have that money you deposit that very first day and that's it. You can keep adding to the growth up to a cumulative amount.
That's awesome.
That's
So
great.
Lots of different opportunities
Yes.
and options for us. Can you give me an example of when laddering worked for someone?
Oh, yeah. I'll use my own family as an example.
Awesome.
When my grandparents passed, my mom got the house when they died, and she was able to sell it. And I found out about a year later that the money they had gotten from that sale was sitting in another financial institution in a checking account,
Oh, dear.
earning absolutely nothing. And so I talked to my parents and I said, Mom, but what are we doing here? And she says, well, I might need access to the funds. And I said, okay, that's true. How much of that do you think you might need access to? And so she gave me the amount, and I figured out we could essentially divide that into 6 buckets. And I said, okay, that first bucket, let's put into a money market account. It will always be available. You can get to that money anytime. And then we built that 5-year ladder. And so I said, all right, so you'll always have this first bucket, and then you'll always have that second one coming due within a very short time. But that way we can just kind of keep that 5-year ladder going. And I was able to show her the difference in what she could earn. And they were giving away thousands of dollars a year. Again, same institution, same risk, but they were just giving up the opportunity to make the money that they already had saved work for them.
I love that you say they're giving up that money.
Right.
Right? Because really, we can, and this was explained to me when I was in high school, either you're paying interest or you're making interest.
I always heard
right?
it, those that understand interest earn it, and that's the thing is, I don't blame anyone for not really understanding how to optimize their earnings because, like my dad, he was a bricklayer growing up, very smart man. But my mom always said, he's a good saver, but he's not necessarily a good investor, so he always knew how to save money and plan ahead and set funds aside. But knowing how to optimize that to really make sure he was maximizing what he could earn, that's a skill that a lot of people, through no fault of their own, they may need some help with. And that's where we at Mountain America, we have people that do understand this and would be very happy to walk you through any of it.
Yeah. So for all of us that can't sit down with Chad Curtis and have you review our checking account balances, right? Like your mom.
Right.
There are other people we can all come meet with.
Oh, absolutely. Our branch employees, our wealth advisors, our service center, we have people that are very skilled in all of this.
Awesome. Awesome. How else in your mind could we fit certificates into our financial plan?
Okay. Well, one good way of doing it, you look at the environment we're in right now where rates are rising so rapidly. You're seeing a lot of focus on what they call bump certificates these days. That's another great option. So we talked about growth certificates.
Yeah.
How a bump works is you open a certificate today, sometimes with a little bit lower rate than what the market rate would normally be. But in return for that, you get an option to, at some point during the term, if rates have gone up, you can now just bump your rate up to that new market rate.
Okay.
And why that's so important, especially today, is let's say there's someone that's kind of, let's go back to your example. They have a few $100s and they really want to jump in and open a certificate because they know they're not earning very much on a basic savings account. But they look at that and think, oh, the Fed's been moving so much recently. If I wait another month or two, the rates might be even better.
Right.
And so they hold off and they keep holding off. And in the meantime, what they're doing is every month that passes, again, they're giving up the opportunity to have earned a little bit more on that. So where a bump option really comes in handy is they can go ahead and get into a certificate today and enjoy those much higher rates that they could be earning while it kind of protects them. Because if rates do go up on that product in the meantime, during that term, they can bump up to that new rate. And for the rest of that term, that's the rate they'll earn.
Okay.
So
awesome.
It's kind of you get the best of both worlds. You can jump in today knowing that you're getting a good rate, but you also have the ability to get an even better rate if that one comes along.
You mentioned when rates increase, we're able to move to that next rate. So is that something I'm watching out for? Is my financial institution calling me and being like, Kristalina, you can have more money?
Typically, we won't reach out.
Okay.
So what will happen is most institutions are very good at making their rates very visible.
Yes.
You might see a billboard. You can certainly always go to the financial institution's website. And again, there's never a guarantee that rates will go up in the meantime.
Sure.
But if those rates do happen to increase, and we are in a rising rate environment now, if that rate is higher and you want to take advantage of that, then you'd typically contact your financial institution and just say, I'd like to exercise that bump option. And for the remainder of that term, your rate is now higher.
Okay, I love it. I love it. So kind of to wrap things up a little bit, I want to go over some key points. One being that we need to review the debt that we have.
Yes.
Right. And then really let's make our money do some work for us. So you're telling me, even though we're going to the grocery store and paying, what did you say, 11% more for the food that we eat, and we won't even go into percentages of what we're paying for gas now.
Right.
But there's still hope.
Absolutely.
Okay.
And, this too shall pass. Things are transitory, even if they don't feel like it at the time.
Yeah.
I will say the Fed's actions seems like they're going really hard, really fast. But I will say that it is working, because what they're really trying to do is by increasing those interest rates, they're just trying to slow the economy down and keep those price increases that we're all seeing down a lot more than they are now. Once they've done that, I think you'll see them plateau or even maybe start to reverse some of these rate increases we've seen. It all depends on how those inflation numbers look.
Okay.
So I just want people to understand that the Fed has had to move at a pace that we're not used to seeing. Usually when they increase rates, it's little bite-sized pieces at a time, maybe 0.25% at a meeting. We've never seen 0.75 increases like we have in decades, let alone multiple in a row.
Right.
And that's just because inflation, due to all these influences we've talked about, just came on so fast. They're needing to kind of react in almost a similar way. But once they're able to accomplish what they're trying to do, it's going to get a lot better.
Okay.
And so I just want our viewers and our members to understand, we know it's painful, but it is temporary. It will not last forever. And in the meantime, we here at Mountain America, we have people that can look at your financial situation and we can help you figure out where you need to go from here, whether you're borrowing, whether you're saving. Our whole goal, the whole reason we exist, is to help our members get to a better financial place and help them feel a lot better about their finances. I mean, in a way, some people don't really understand their finances very well and don't even know where they are in terms of budget, in terms of savings, or where they should be. And so much else in life is stressful right now. Hopefully that's one stress that we could help reduce a little bit.
I love that. And, one person described it to me this way is, I'm not a specialist when it comes to finances. Just like I'm not a specialist when it comes to building my house, right?
Right.
Like I'm not paying to go out and learn those skills to build my own house.
I'm not a general contractor, right?
Exactly. So yeah.
Well, and I've always
let
kind of
us help
used
you.
a health analogy, right? It's like if I go into the doctor, I might have a sense that my health maybe isn't where it should be. And sometimes I might be embarrassed to have the doctor tell me, you could be doing better in this area or this area. And hopefully I don't take offense at that, but I see that as an opportunity to say, yeah, I could be healthier. And I'm actually excited to get to this better situation. So hopefully our members don't feel embarrassed to come in and, essentially let people see their finances. And I think it's exactly the opposite is we're not going to judge. We're not going to mock or anything like that. I think if anything, we're going to be looking at that and saying, you know what, knowing our products and services, there's a way we can take where you already are and get you into a much better place. And so if we can help, again, remove some of that stress, that's why we come to work each day. We love those stories where someone comes in for a routine transaction and in looking at that member's situation, we're able to suggest products and services to say, we can take you exactly where you are right now and immediately improve this and free up money you didn't even know you could free up. And that will enable you to achieve some of these goals you're trying to achieve. That just makes our day.
Yes. And even take advantage of crazy rate environments.
Absolutely.
Right, that we're
you can make them work for you.
Awesome. Well, Chad, thank you so much for joining us.
My pleasure as always. Thank you.
Yeah. And thanks to all of you for joining as well. And we will see you on the next episode of Guiding You Forward.